Hello, Shannon Grimm with Shannon Grimm and Partners. Thanks for joining us today. I am with my trusty sidekick, Mike Stanley, better known as just Stanley. And we are joined today with Mike Beatty, who we just call Beatty because there are too many Mikes in this world.
Back again. Thanks for having me again.
Yes. So he is here to talk about all things mortgages from Howard Hanna Mortgage. And we'll get into some do's and don'ts. And then maybe do another podcast on special programs that you have from Howard Hanna.
Yeah, that sounds great. So I wanted to come in today with the topic of talking to you guys about 2025. A lot of people have New Year's resolutions coming up, and I'm sure a lot of people's are to buy a house in 2025. So thought it was a great time to just send out some reminders to people on things that you should be doing, things you shouldn't be doing, so that it doesn't hinder your home buying process when you do become ready to do so.
A lot of people think that these things are just myths.
No,
they are not myths. Back when Sears was still around, there was someone walking around and they were talking about they were getting a new house and they were buying a new washer and dryer, and closing was in 2 weeks. And I'm like, no, you can't do this. And she was like, oh no, I'm getting them in my friend's name. And
I
I'm
remember
like,
you telling me that story,
yes.
and just kind of I started twitching.
I know, like, oh thank God.
People don't believe us, do they?
The things we don't like to hear is new furniture, new car.
Correct.
Yeah, I had a furniture store employee call me. God, this has been a couple of years ago, saying, hey, I've got a guy here looking to furnish his new home and he hasn't closed yet. Should we grant him credit? I'm not even kidding you.
That's a good
least
employee.
they called you.
That is a good employee.
Yeah, the employee called at the permission of the client or the customer.
Right.
And I said, absolutely not. You guys need to wait until after closing before you open up any new credit card debt, store debt. Installment loans, car loans, anything
No
like
new
that.
debt is a very serious statement. No new debt.
I think that's pretty much number one
Yeah.
on my list here
No
of
new
don'ts. If you're looking to buy a house, the last thing you want to do is open up new debt for two reasons. One, every time you open up a new credit card or a new trade line on your credit report, your credit score is going to be impacted. Albeit it may be temporary, it may be for a month or two, but anytime you open new debt, your scores drop, regardless of your intentions. And then the second reason is most people are going to open up new debt with the intentions of buying something, right? They're opening up a credit card because they're given 0% interest for the first 24 months, so let's go get that new giant screen TV or the new couch or whatever it is. So when you do that, not only does your credit score drop because you just opened new debt, but your credit limit, you're going to be adding credit, which has a monthly minimum payment to it. And when it comes to qualifying about mortgages, it's all about money in and money out. So if you're going to open up a new charge card and put $5,000 on it because you got to have this new home theater system, guess what? That's probably a $200 a month minimum payment that you now have to put into the debt ratio.
And you're probably going to want a new home to put that into.
Yeah.
So
Let's not put the cart before the horse.
yeah, and we've literally had someone who got disqualified for a mortgage because they had bought a washer and dryer right before closing. And what people don't realize is, first of all, you're going to ask them multiple times, depending on how long the process takes, for them to verify their bank statements and things like that, their pay stubs and everything. So that's pretty standard. But what you can also do as a lender is you can pull everything the day before closing.
And we do.
And most do. And then it hit that these folks had bought a new washer and dryer, and then they weren't able to close because that just knocked them over because they were so close on their ratios. And yeah, that's what people got to understand is those ratios, there's no give there. It is what it is.
That's correct. Numbers don't lie,
Yeah.
in other words. So, yeah, and that's such a preventable thing, you know. So I guarantee you nobody felt as bad as that client, that buyer, you know. And what do we do to make it right? Well, you pay it off, you close the account, and you wait and see what kind of impact that has on your credit. So that is probably the number one thing that we tell people not to do. And literally it says apply or take out new credit cards, auto, personal loans, or have new credit inquiries on your credit report during the course of your loan being processed and underwritten.
No new credit for you.
No new credit. No new super. Yeah.
Just stick to food and gasoline for that month that you're in contract.
Yeah, right. And so, you know, a couple of other things that really come to mind when you're going through this process is please don't change jobs.
Oh, dear God. That happens all the time.
You would be shocked at the number of times we run into this.
Unfortunately, probably not. But
Yeah, well, we do all the time.
Yeah.
And when you're changing jobs, there's a few things to keep into consideration. Are you salary? Are you hourly? Are you getting hired by a temp agency to then go permanent with the company? I'm thinking Honda, right?
yeah, temp agencies are a huge problem.
They are, and people don't realize it because they're employed. They think they
Even
have
the
a job.
traveling nurses, because they operate on contracts.
Correct.
And their contracts have a set start and set end.
And they make great money. And
They do.
But it's that employment history that's it's difficult.
And people think, oh, I switched jobs, but I'm still in the same field. Well, guess what? You went from a W-2 to a 1099, and now you're not. Now you need 2 years of being self-employed 1099.
Yes, absolutely. And that's a big one right there.
We see that all the time.
Another
like every
big
week.
one. Another big one that we see is with anybody who works outside. It could be union, it could be just construction workers, landscaping, anything that is weather related. And the reason why I bring this up is if you have what's called variable income, and that just means that no two paychecks are alike. Maybe 1 week you're working 50 hours because the sun is shining and there's no rain. The next week it's raining 3 of those days. And so you're only working 30 hours the next week. Well, when you have that basis of variable income, you typically have to be at your current job for 2 years so that we can take a 24-month baseline to calculate your income. So I've actually had clients who have been with their jobs for 3-4 years, made a change because they're getting paid more hourly rate, but it's still variable hours at the new job. So they have to wait 2 years at that new job before we can average the income. That's a big one.
Yeah, that's one that you don't necessarily think of either.
Yep, got to be
Is it
40
okay,
hours
what-
straight guaranteed or salary. Those are the two exemptions to that 2-year mark. So changing jobs is a no bueno.
Yeah, no go.
Yeah.
Yep.
Another one that we run into, and then I'll let you guys ask any questions, but another one that we run into that always presents a challenge of sorts is undocumentable deposits into your bank statements.
Yeah.
So part of the process is we're going to get 2 months of your most recent bank statements, and we have to get all numbered pages.
You're going to get them multiple times.
Yes. And if we see a, say, $5,280 deposit, and it's not a payroll deposit, guess what? We got to find out where that money came from. Again, I got to hesitate to say this, but I kind of am surprised at the number of people that actually still keep a large amount of cash in safes or under their mattress in their house and just don't trust banks.
I think we got a proof of funds one time in the form of a picture of a suitcase full of money.
Correct.
Yeah, and the federal government doesn't allow us to count
I don't
that.
really like that.
No, it throws up a few red flags.
Yeah, and I just ran into one last night, transaction that I'm closing out here. And the buyer, just the lender that they're using, they've used before. I've never dealt with them, haven't even heard of them before. They've bought multiple properties through them. But what came up yesterday, 2 days before closing, is the fact that he's collecting rent from someone in cash, and when he deposits it in his account, the deposits vary. So why this lender, who's done multiple transactions with this person, would wait till 2 days before closing to point that out, and now that's going to possibly be a problem, I just don't understand.
Without knowing the true
Right.
history of it, the only thing that comes to mind on that is if they had a bank statement that had expired and they needed to get a new bank statement because of the cycle dates before closing, and if those deposits weren't on the previous bank statements, and all of a sudden we get an updated bank statement and see all these cash deposits, yeah, it's going to throw up a red flag.
But cash does not always help for some reason. So if you're taking money from people in cash for payments for stuff, then that doesn't really help you either, especially when you're not depositing them the way they should be deposited.
Yeah.
What's the seasoning time on money? Not 90 days, is that correct?
Well, here's what I'll say, and I got to be careful how I put this. So we get 2 months of your most recent bank statements. And if we see the deposit, we have to chase it back to its original source. If we don't see the deposit, we don't ask. And I'll just leave it at that.
Yeah.
Another one is people who sell motorcycles ATVs, things that they own.
Oh.
And say, you know what, I've got an ATV I haven't ridden in 2 years, is sitting in my pole barn, and I'm going to sell that to get down payment funds for my mortgage. So that's another one that kind of takes us down another rabbit hole, if you will. We have to get proof of ownership. We have to get a bill of sale signed by both parties. So it usually means, like, if it's an old vehicle or a hot rod or something like that, you have a title somewhere. You've got that title showing ownership. But we always remind everybody, or at least at pre-approval stage, hey, if you're doing that, and I usually try to have a conversation with them to see where their funds are coming from, then I'm going to coach them to say, okay, we need a copy of the title, we need a full signed bill of sale, and don't take cash from the buyer. Have them write you a check. Or get a cashier's check with a copy, so we can see that it was a legitimate transaction and not just paid with
and then
with
put it
physical
directly
dollar
into
bills.
your account.
The exact amount.
Yeah.
That's another good
Like,
point.
take it and put it directly into your account.
That's another great point. So when you do something like that, don't take, say you sell a motorcycle for $3,000, don't take the $3,000 and deposit $2,500 and keep $500 in cash to go out and buy something or go out to dinner or go on vacation. Deposit the exact amount of the sale so that they match dollar for dollar. That's important.
Yeah.
Because those throw up red flags. They don't
Well,
match.
I mean, it's I've seen it with one of our transactions that I've done with you. It's like CSI for you guys when you have to, and that's why it's great that you coach people, because when people go off and do their own thing, all of a sudden you're tracking down every transfer, every transaction, and all this money in, all this money out. Where's it coming from? Where's it going? And it's literally like a crime scene pegboard trying to track things around. It's impressive.
It can be arduous process, trying to track all this down. So, the key to remember that is no large money movement. Don't
Just
move
don't
all your
move
money
any.
around.
Put stuff where you want it to go and leave it, and then buy a house.
Correct.
So make any movements before you start the loan process.
And we see people who do move money around. They'll get paid and they'll move it from their checking to their savings, and then they'll transfer some money over to their roommate to pay them for rent. So
We've seen some weird stuff.
yeah. So the less money movement, the better if you're looking to purchase a home.
So if somebody isn't quite sure where they are, because again, they'll go use like something like Credit Karma, but that doesn't quite give them the picture for buying a house. That just gives them a picture for whether or not they can get a credit card or buy a car. But your credit score and everything for purchasing a house is a totally different scenario.
Oh, I have this conversation multiple times a week with just about every client that I work with now at the pre-approval stage, because I think you could say that, and I'm making an assumption here, but I'd say well over 50% of the adult population probably uses or has looked at Credit Karma or CreditWise with Capital One or any of the free credit reporting apps. Pardon me. So what I coach everybody on with that is that there's two different scoring models when it comes to credit. There is the Vantage scoring model, which is what Credit Karma uses, what CreditWise uses. And then there's the FICO model, which is what any lender is going to use. Here's the biggest difference, guys. The Vantage, I want to say 2.0 or whatever it's called. Please don't quote me on that. But with that, it pulls from 2 agencies, not 3. It does not show up as a credit inquiry on your credit report. It is designed for the consumer to be able to monitor their credit without having an impact on their credit scores. So the method of their scoring is just completely different because of that. Whereas when you're applying for a mortgage or any type of loan, really, it can even be a car loan, using the FICO score model is pulling from all 3 credit agencies, TransUnion, Equifax, and Experian. It's going to show public records, collections, past issues, whether there's any fraud alerts. So it's a much more detailed credit report, and the scores are typically different on the FICO than they are for the Vantage score. So it's a great tool to monitor your credit. So with anybody I'm working with that may be a little far off from being able to purchase, whether it's credit, whether it's savings, they're just trying to get to me early, which we'll talk about that in a few minutes. But whenever they do that and they say, well, I know my credit score is a 765, I'm going to ask them where they got that score, and we go into that conversation, and then we'll pull their credit, and they understand the difference. And they understand why I need to pull my credit report when we do a credit inquiry or when we do a pre-approval. Because a lot of people want to use, here's my Credit Karma. Can't you just use that?
Right. Don't pull my credit. Use this.
Yes, correct. So and
they're great tools to use. It's great tools for the consumer to have the access to that, but it's not a snapshot of their actual credit that they're using to qualify for the mortgage.
Correct. It's a good tool to monitor your credit is what it is. And I tell people, hey, you know what? You'll see the trend. So if you need to pay down some credit or if you need to pay off some collection accounts to get your score to where it needs to be, monitor your Credit Karma, and you're going to see the credit scores going up over time. And once you see that trend going up for a couple of months, let's revisit this. And then we can pull our FICO model and see if it matches or mirrors or went up from our first inquiry. So that kind of brings us to another topic. And I'm sorry, give me 1 second. And that is
talking too much.
Jeez, Pete, old man.
Wow.
Let me get like a nebulizer in here for you.
That hurts. That's deep. That cuts deep.
It sounds like it's deep in here, actually.
Hey, well, I'm just getting over a cold. No. So it's something Mike and I talked about earlier, and that is the Mike and Mike show. When do you really start the process? When is the optimum time to start looking at your financing abilities when it comes to buying a home?
It's never too early.
It's never too early.
And that doesn't mean that you have to have their credit pulled and do a pre-approval. This is a small look into what they might need to do.
Correct. I always encourage everybody that if you're looking to purchase a home in the next 6 months or so, and maybe even up to 9 or 12 months, it's good to get a baseline to see where you're at. Hey, it could come back and say, you have absolutely nothing to worry about. You're good to go whenever you're ready to go. Or it could be somebody who has maybe, and take this as an example, they maybe have a 675 credit score. But if we can get them up to a 700 credit score, the pricing is going to be better. The interest rate and the terms of the loan are going to be better. So if you're 4 to 6 months off from purchasing a home and you're just starting the process, I can guide them and say, in looking at your credit, if you were to pay this maxed out credit card down to 50%, you're going to see a market improvement in your credit. Or, hey, you've got this lingering collection that's been sitting out there for about 5 years, and I get it, it's on principal, and I get it, it's only $150, but it's impacting your score. Go ahead and pay it off and fight it later. It's $150. Just get it off of your credit score or credit report because it is impacting your scores. So I can coach people like that, just a couple of examples on how we can actually get their scores up in a very short order. It doesn't take long, maybe one reporting cycle, maybe 2 reporting cycles. And then it just makes us all look good. They get better terms. Maybe they can afford a little more house because they had to pay off a couple of credit cards to get their debt ratio. You got it. So it helps the debt to income ratio come down. So to that point, it's really never too early to start the process. If you're looking in 2025 to purchase a home, give us a call. And we'll take a look at everything and let you know if there's anything at all you need to work on.
Okay. Yeah, and that's huge. I know, because then you can start to move into, you need to pay these things off to possibly help your credit, and go over that with them. But then the discussion starts, well, that's impacting my down payment. Well, you have programs, and we'll talk about those on another podcast, to help in those situations as well. So there's a ton of options, and people just don't know if they don't ask. And if they come in blindly, like, I'm ready to buy a house within the next month or two, that might be possible. But if maybe you came in 2-3 months ago, like, we really could get things set for you, educate you, and help you get in the position to be ready to go when it's time.
And it just makes for a smoother transaction in
really
general
does.
When you're ready. So that brings me to another point that is on my list. So, great segue. God, and we didn't even plan this, I promise you, we didn't. But the other one is getting your paperwork together as soon as possible. So I always encourage everybody to get a folder, get a manila folder, and start putting all of your bank statements in this folder. Start putting all of your pay stubs in this folder. Get your tax returns, your W-2s, your 401k statements, and have a house folder prepared, whether it's an accordion style or just a big manila folder, if you will. And the reason why I encourage everybody to do this very early and make a habit of it, even if you end up with 5 or 6 bank statements in there, because when the time does come to formally apply for the loan, they don't have to scramble around for a week to find all of their paperwork. They already have it together. So why is that important to have the paperwork ready to go right at the time of application? The name of the game these days is what? Fast closings. And if we can have all the paperwork ready to go on day one, then the odds of us getting this loan closed in lightning speed, freaky fast. No, I can't use Jimmy Johnson. Sorry, it's lightning speed. The key is having everything ready to go. And it's so important and makes the transaction so much smoother and easier.
And what's, I know the answer to this, but what's the typical timeline for a conventional loan to in contract to closing? What's the typical days?
You're really going to ask me that?
I would love to hear the answer. What's the typical number of days? Not for you, but in general.
Yeah, that's a tough one to answer, but I would tell you, average time from application to close anymore is probably 21 days. Maybe a little less than that. And that's just technology. That's being prepared. That's coaching your clients. But it helps in a competitive market.
I think that's typical for you. I'm just throwing that out there.
Which is really good.
Which is really, really good. I still have lenders that some buyers will bring or that are purchasing a listing of mine where it's last minute at the 29th or 30th day, and we're scrambling.
Yeah,
I'm scrambling to get them to get something done, but it's a problem. And I have one that's getting ready to close with you that is clear to close in 20 days, but probably could have been clear to close sooner if a couple of things got in quicker. But they had everything ready to go.
Yeah.
And
day one.
And that made the offer look better, too, because we put in the offer when it was going to close in 21 days. Most people put 30. Some put 45 even. But showing 21, that's huge.
And that's part of being prepared up front, right? And that's what we try to do, is get everybody prepared up front so that we can do that. And we can help you guys win offers. So having a good relationship with a lender and a realtor will help any buyer. In my opinion, as a lender, is going to help any buyer have a much, much better experience as far as how quickly things move, communication, and getting things closed and not having you scramble around at the 11th hour.
Exactly.
Nobody likes that.
No. So the key takeaways from this podcast should be: don't buy anything new if you're trying to buy a house.
Don't change any jobs.
Don't make any changes at all. And just freeze. Stay right where you are for 30 days.
And, here's what I'll say to that also is life happens. And we do get that. So what happens if somebody's car breaks down? What if they get into an accident and they have to go out and buy a new car? The one thing I encourage everyone to do, and this is something I coach all my pre-approvals on as well, is call me first. Before you do anything, let's have a conversation. Don't just make any snap decisions that are going to impact your approvability and your ability to buy a home. Because maybe you want that $55,000, Yukon Denali. But,
oh, dear.
Well, I'm just saying, and that would be a used one, Mike, I know.
I was just getting ready to say
I saw
90 to 100,000.
I know, yes. but my point being is that $600 car payment, $800 car payment makes a big difference from a $500 car payment.
Sure
and what's
does.
More important, the car or the house?
Right.
So I like to have those conversations, and there's some people where it has no impact because they're not maxing themselves out to begin with. But there's other people that I have to say, hey, I'm sorry, no, but you can't. You just can't do it. One or the other. Do you want to live in your car or do you want to live in a house?
Right. So, all right. Well, that is going to be it for this episode. Thanks for joining us. And Mike Beatty with Howard Hanna Mortgage.
Thanks for having me.
Woohoo!
And if you want to get to him, you have to get through us first.
I'm okay with that.
But thanks for watching. And until next time. And make sure to like, follow, subscribe.
Like, comment, subscribe, and hit that notification bell.
Thanks
for Shannon, Grimm, Realtor.
Yep.
Thanks for having me, guys.
Thank
and
you.
614 Real Estate Nerds.